Okay, so you're getting a mortgage and you're hearing all of these terms getting tossed around and you're thinking, what is all of this? Prepayment, down payment, closing costs, interest rate. What are all these things? This is confusing. Look, I can't possibly explain them all in one video, but what I have made is this video that will give you a good foundation to some of the mortgage terms and terminology so that you know exactly what you're doing when you're arranging your financing. My name is Isco, mortgage broker here in Ottawa, Ontario, but we service the entire country. So here we go. So let's start off with applicant and co-applicant. These are the people that are going to be on both the mortgage and on the title of the property. Next, we have guarantor. A guarantor is somebody that is added to the application to strengthen it, typically somebody that is co-signing. So these individuals are on the mortgage only, but they are not on the title of the property. Loan to value. Loan to value is the percentage of the home's value that is being financed. So if it's $1 million property and there's a $500,000 mortgage on it, that is 50% loan to value. Pre-approval. Pre-approval is a process that you go through, which allows you to get pre-qualified and to understand what terms and pricing that you would qualify for. So this is typically done before you go out and start shopping for a home. Actually, a must do. Interest rate. This is the rate of interest that is being calculated on the total amount that you're borrowing, and this will determine your amortization and your monthly payment. Fixed rate mortgage. This is a type of mortgage product that results in having a fixed rate throughout the entire term. So example, you have a 5-year term, fixed rate term, which means that your monthly payment and interest rate will stay the same for the next 5 years. Variable rate mortgage. This type of mortgage product is priced based on the lender's prime rate, which is related to the Bank of Canada's key lending rate. So with a variable rate mortgage, any increases or decreases to the prime rate will affect the mortgage payment. So any increases to the prime rate result in a higher mortgage payment, whereas decreases will result in a lower mortgage payment. Term. This is the duration of your mortgage where you have your terms and pricing in place. Most common terms in Canada are 3 and 5-year terms, but there are 10-year terms available. Amortization. This is the duration required to pay off your mortgage completely, assuming you have not made any changes to it during that time. Closed term. Most terms in Canada are closed term, and if you're on a closed term, it means that you will have to pay a penalty if you break the mortgage prematurely. Open term. If your term is open, it means that you can break the mortgage at any time without penalty. Open terms are typically more expensive than closed terms and are really designed to be short-term solutions. So somebody selling their home would maybe want to be on an open term to avoid any penalties. Maturity date. This is the date when your mortgage term is completed. This is typically when you would transfer to a different lender, renew with your existing lender, sell the home, or refinance. If you complete one of these transactions on the maturity date, you won't have to pay a penalty for breaking the existing mortgage. Renewal. Your existing lender will send you a renewal offer within 3 to 6 months of your maturity date. They will offer you different terms and rates to choose from with the hopes of having you stay with them. Assuming you have made all your mortgage payments on time, you will not need to requalify for the mortgage or provide new income documentation. Transfer. If at renewal you want to change lenders and keep your existing mortgage balance and amortization the same, you will be doing a transfer to a new lender. Refinance. If you are looking to increase your mortgage balance to take out equity or pay off debts, you are refinancing. Some people also refinance to increase their amortization so that they have lower mortgage payments. A lender. An A lender typically has market competitive terms and interest rates. They do not charge a lender fee. There are many A lenders outside of banks and credit unions. These lenders typically require good credit and verifiable income. If you are buying a home with less than 20% down, you are with an A lender 99% of the time or more. B lender. These lenders come with slightly higher pricing than A lenders, but are much more flexible with their requirements. They are great for people with bruised credit, self-employed individuals with a small amount of money declared on their taxes, or anybody in a unique financial situation. You must be putting down 20% or more to access these lenders when purchasing a home, or if you're refinancing, your loan to value must be 80% or lower. Private lender. These lenders offer short-term solutions for those that cannot access financing from A or B lenders. They are more expensive than A and B lenders, but require very little to approve you. Their main requirement is a loan to value of 80% or less, reasonability, so how are you going to pay these payments, and a strong exit strategy. They typically offer 1-year terms with interest-only payments and want you to move to another lender when your 1-year term is up. Lender fee. This fee is charged by B lenders and private lenders when you initially secure a mortgage with them. B lenders typically charge 1% of the total financed, while private lenders charge more. If you are purchasing a home, this fee is payable on closing. If you are refinancing, this amount will be coming from the proceeds of the refinance. In most cases, B lenders do not charge a fee to renew their mortgage, while private lenders do. Broker fee. A mortgage broker may charge a fee if they are arranging a mortgage for you with a B lender or private lender. In most cases, B lenders compensate the broker much less than A lenders do, so brokers have to charge a fee for their work. In most cases, private lenders do not compensate the broker at all, so brokers may charge a higher fee on private mortgages than they would with a B lender. Appraisal. If you are buying a home with more than 20% down or are refinancing, the lender may want a licensed appraiser to complete an appraisal report to confirm the value of the house. If you are buying a house with less than 20% down, transferring or renewing your mortgage, you likely won't need an appraisal. House inspection. Not to be confused with an appraisal, this is a service that buyers arrange to get an understanding of the condition of the home that they're looking to buy. This report won't include anything about the value of the home and is typically not required by a lender. Deposit. When purchasing a home from a builder or person, this is the amount that you leave when you sign the purchase agreement. This amount is typically a portion of your overall down payment, but will eventually go towards it. Down payment. This is the total amount of money down that you are required to put when you're purchasing a home. Closing costs. This is the amount of money that is required, in addition to your down payment, to finalize your transaction. In Ontario, this is typically estimated at 1.5% of the purchase price. Condition of financing. When purchasing a home, you can include this condition with your offer to protect you. If you have a 5-day condition of financing, it means you will have 5 days to secure your financing. If you cannot secure financing during this time, you may walk away from the deal without penalties and have your deposit returned to you. Closing date. When purchasing a home, this is the date that you become the legal owner of the property. If refinancing, it is the day that your new mortgage is finalized. Insured mortgage. If you are purchasing a home with less than 20% down, you have an insured mortgage. This means that the mortgage insurance premium is added to your total amount financed. Mortgage specialist at the bank. These are individuals that work at the bank and can only offer you mortgage products that are from their employer. Mortgage broker or mortgage agent. These are individuals that have many different lender options and are not loyal to any one lender. So that's it for today, you guys. We covered a lot of terms, but of course, I know there are much more. So if there are other terms that you would like to know, please comment on this video and I will be happy to respond to them or maybe even make a video about it. So if you like these videos and the content that I'm putting out, I really appreciate if you click like and subscribe on the video. Thank you.